Hi, it's the Catholic CEO, Henry Kutarna. Welcome to this Catholic Business Wisdom series topic today on taxation. In this topic, I'm going to cover some general comments, first of all. Then I'm going to cover 6 different forms of taxation, 6 different types of taxation. And then I'm going to draw a couple of conclusions for you. And so here we go with some general comments. First of all, taxation is an example of how the coercive power of government, whether for positive or negative, can extract funds, money, from citizens to pay for government services and programs. And I say coercive power because all of the taxation models that I am aware of cannot be evaded. In a certain sense, they are compulsory. And if they are compulsory and you avoid the tax and actually evade the tax by hiding or failing to comply, you will be eventually found out. You will be audited. You will be forced to comply, and you may even be charged criminally in the worst cases. So it's an example of the coercive power of government. Secondly, enforcement. The enforcement of the tax regimes that are known mostly in the Western economies are confiscatory, or there's a penalty added. And I say confiscatory because that means that they can confiscate your property or various other sources of your income and wealth until your tax bill is paid. A classic example is if you don't pay your property taxes on your house, eventually, even though the process might be lengthy, you will lose that property until the taxes are paid, and sometimes unavoidably so. In other words, you will lose the property forever. And finally, jurisdiction. The federal, provincial, and state or municipal governments and special bodies like an HOA or a BRZ, a business rehabilitation zone, or some of these special boundaries that levy a tax are in charge of taxation, and they get their power, once again, from the legislative authority of that particular government, hence the coercive power of the state. So taxation is a very serious topic. It's essential for the governing of an economy, yes, but at the same time, it can have a powerful deflating effect on productivity if it's taken to an excess. And I'm going to close my comments today with a couple of examples of that. Let's move, first of all, then to the forms of taxation. I'm going to mention 6, and they are going to be wealth taxes, property taxes, income taxes, consumption taxes, transaction taxes, and then fees and licenses and charges and tolls and duties and tariffs and so on. First, wealth taxes. There are taxes on wealth. One of the most classic examples is an estate tax. In other words, if you die, or in some cases, if you transfer property, such as to a family trust, or if you leave a country, or if you depart from one jurisdiction to another one, there's going to be potentially a tax on your wealth. In other words, your assets might be taxed. Certainly properties, houses, homes, buildings are taxed in the form of a wealth tax. And so there could be a levy of a percentage of the assessed value of the property or some other proxy for the amount of wealth that you have. And so a wealth tax is usually levied on an asset, a physical asset of some kind, or you might call them a real asset, but not a physical asset, such as money or wealth or bank accounts or money that you hold in the form of things like gold or tokens, like the currency tokens that are in place today, like Bitcoin and so on and so on. So in general, first point is that a wealth tax can be levied in certain jurisdictions on an asset, and that wealth tax can be usually levied at a moment, an event that occurs, such as your death or the transfer or your move from one jurisdiction to another. That's what a wealth tax does. Secondly, property taxes. You'll be most familiar with this. The idea of a property tax is that if you own a house or a commercial building, or even if you lease a commercial building, you're subject to a property tax. And so what happens is there is an assessed value of your property, and then there is a mill rate or a levy, a percentage charge on that property every year. And as your municipality or your state or even your federal jurisdiction needs more money to do its work, your property taxes will possibly increase. They may not just stay the same. And of course, we're used to an inflationary concept where property taxes go up every year. And when the value of the property rises, of course, levying authority gains more money. And if the rate, the actual percentage rate changes, the amount of taxes rises as well. So governments have two ways of increasing their revenue through property taxes. Number one, on the assessed value of the property when it rises, and secondly, on the actual percentage amount that they levy on a regular basis, usually annually. The third type of tax that, again, we'd be familiar with, is income taxes. When you earn income from a salary or dividends or pension or an investment or anything like that, you're going to be taxed on that income. And every jurisdiction, provincial or state or federal, has a set of tax rules. And these rules apply to your income in the sense that you must report that income. You are allowed certain deductions from that income. And so you wouldn't be paying tax necessarily on the full amount, but you'd be definitely paying a tax on a net amount. And on your income, there are different kinds of tax regimes. There's the progressive tax system, which we would be familiar with, where the higher your income, the higher the rate of taxation on you. So the poorest people in a society might be taxed at the lowest rate, and the wealthiest people would be taxed at a higher rate. And so that is called a progressive tax system. There are regressive taxes as well, sometimes inadvertently, sometimes deliberately, where the lowest income people are paying a higher tax than, let's say, the highest income people. And there are examples of that. If the low income families are taxed on their food consumption, let's say, for example, just as a random example, then they're probably experiencing a regressive tax system. If there's, let's say, the jurisdiction had a 5 or 10% tax rate on food, well, for the higher income person, that's not going to be that significant. But for a low income person, it could be very significant. And so you will have the difference between progressive and regressive tax systems. Also on income, there are capital gains taxes. And capital gains taxes are on the increase in value of an asset. So let's say a commercial property, when you sell it, or in some cases, a house, or in some cases, an asset such as a share that you own in a company, stocks or bonds or any financial instruments like that. When they increase in value, there's usually what they call a deemed disposition. That's a date in time where you have to do the calculation, and you have to create for yourself then a net tax situation. You might be allowed to deduct things from that. But capital gains, where there's an increase in the value of an asset, are typically taxed by regimes, by economies, and these are another form of income tax. There could be deductions from that type of tax in the form of depreciation, recapture, or the cost of the sale. Let's say you sell a commercial property, you might be allowed to deduct the cost of the realtor fees and the activities required to sell that property. Still, you're going to pay some form of tax on the net capital gain as well as on your income. The fourth type of tax is what we call the consumption tax. And these are what they call value-added taxes, VAT taxes. In Europe, you'd be familiar with the term VAT, VAT taxes, or in Canada, the GST, the goods and services tax. And what happens here is when you make a purchase, you're going to have to pay an additional, not just a sales tax, which we'll talk about in a moment, but you're going to have to pay your VAT tax or consumption tax on top of that. You can usually deduct from your tax bill all the taxes that you yourself have paid at different levels of the value chain. So, for example, if you're running a company and you have to buy paper, you're going to pay some sort of a VAT tax, consumption tax, GST on that quantity of paper, but you might be able to then deduct the expense of when you buy gas to drive to the paper supply company or to pay for the shipping. You're going to also pay tax at that end. And so you'll be able to deduct those two items, one from the other, and you'll end up paying a net consumption tax. In other words, the difference from the tax that you pay yourself and the tax that you charge if you're a consultant, let's say, is your net tax, and that you will be taxed on that. Usually that's done on an annual basis if you're a low income person in the sense of a small business, or it could be done on a quarterly basis if you're a mid-sized business, or of course monthly if you're a large corporate business. And so the governments are favorable to consumption taxes. There's a body of thought that says that consumption taxes are more fair and equitable because no matter what your income, you pay, it's called a flat tax in some instances. And so, for example, if I recall correctly, in Hong Kong, when it was still a British colony and I used to travel there on business, you would be taxed on all of your consumption at 15%. And so no matter how much or how little you bought, your tax would be a flat tax, same rate. And so the yield from that tax would be very high from high income people or high consumption people, and low from the lower income people. So that's the consumption tax. Number 5 is what we call transaction taxes. You'd be most familiar with sales taxes. So when you buy something at the store, you go for groceries, you buy gas, you buy any clothing articles or anything like that, recreation, you pay for a trip, you're going to pay a sales tax. And the sales taxes usually are levied by a province or a state, often by a city. If you go to a resort, you'll pay a hotel tax, which is on top of the sales tax, as an example. Or there might even be a federal sales tax on certain products and services. There are exemptions to sales taxes. So sometimes governments will do things to try to attract votes, like, for example, no sales tax on children's clothing. There might be no tax, or there might be a lower rate, or they might be what they call zero rated. In other words, they will have the chance to increase those taxes someday, but at the current moment, they might be zero rated. So transaction taxes, sales taxes are what you're most familiar with. Finally, there are, I call them general taxes, and I'm going to list a set of terms here that you'd be familiar with. You could pay fees, you could pay a license fee, you could pay for rights, like drawing water from a river. There might be a tax on that. You can pay charges. There can be tolls on freeways or on navigable waterways. There can be permits. You buy a permit. You want to make an addition to your house. You have to buy a building permit, and you have to qualify for that. And the building permit will then cost you. That's a form of taxation. There might be duties. There might be tariffs. There might be import and export fees. There's all kinds of fees. Some of these are hidden fees. Some of them are added on top of the transaction. And so you'd have to watch and be careful that you understand the difference between the hidden fees and the visible fees. Finally, I'm going to close with a comment about taxation in general. Taxation, while necessary for the governing of a country and the running of an economy and to pay for public goods and services like infrastructure or defense or things like that, there can be excesses. And because human beings are flawed and our governments are not perfect, we're going to find that generally speaking, the trend is towards high tax jurisdictions where we're taxed at increasing rates on a lot of different things. And so the total tax bill that you would pay as an individual or a business owner can be very high. And so this is why the concept of the Tax Freedom Day has arisen. For example, in Canada, the concept of Tax Freedom Day is that all the income that you earn from January 1st in a given year, all the income that you earn, you're going to pay in the form of taxes of all these different kinds that we've talked about today. And so Tax Freedom Day in the Canadian federal system is considered to be sometime in July. So that means that more than 50%, more than 6 months worth of your income, every dollar, every penny that you earn, goes to some form of taxation. you can see how that could be a disincentive to productivity or to, even even to live and subsist. In the United States, Tax Freedom Day is somewhere in, I believe it's early June, late May in some jurisdictions. And the point is, the US is generally a lower tax regime than say, Canada. The concept of Tax Freedom Day is a calculation. Governments don't like to know that concept. They don't like that you understand that. But generally speaking, you will always find some economists and some publications and sources who will define Tax Freedom Day in your country, in your city, in your state, or your province. And the concept then is valuable because it helps you to understand the total impact of all your taxes. So there you have it, a little summary of taxation. It's a powerful topic. There's a lot of technical work that I could do with you on the impact of taxations in the form of tariffs and subsidies, but we won't cover those today. The Catholic CEO, Henry Kutarna, thanks for joining us today, and we'll see you next time.